Welcome, fellow enthusiasts of financial wisdom and investment acumen. Today I invite you to embark on a captivating journey as we delve into the timeless classic, The Intelligent Investor, by the brilliant mind of Benjamin Graham. In this video, we will unlock the treasure trove of knowledge contained within the pages of this iconic book. Discover the keys to successful investing as Graham presents an intellectual framework that transcends fleeting trends and volatile markets. The Intelligent Investor stands as a beacon of timeless wisdom, guiding both seasoned investors and novices alike towards sound decision-making and emotional resilience. Graham's profound insights have shaped the investment strategies of countless individuals over the last century, leaving an indelible mark on the financial landscape. Join me as we unravel the core principles, explore the invaluable lessons, and unveil the secrets that have propelled not only Graham but also his disciples, including the legendary Warren Buffett, towards enduring success. Takeaway number 1. Encounter the enigmatic Meister market. Imagine you have a collection of rare stamps that you acquired for $1,000. Every day, a peculiar character named Mr. Collector comes to your doorstep, offering an opinion on the value of your stamp collection. He even proposes to buy some stamps from you or sell you additional ones based on his assessment. However, experience has shown that Mr. Collector's opinions about stamp values can be utterly nonsensical. For instance, back in April 2005, he claimed your collection was worth $3,000, but just a year later in April 2006, he insisted it was only worth $200. Now here's the twist. Despite the fact that the rarity and desirability of the stamps in your collection increased significantly during that same period, should you rely on Mr. Collector to determine the worth of your $1,000 stamp collection? Absolutely not. One of Stamp Guru's fundamental principles is that a stamp is not just a piece of paper with a price tag. It represents an ownership stake in a world of history and art. And because Mr. Collector can be irrational at times, the intrinsic value of your stamp collection may diverge from the price he is willing to pay for it. In fact, his assessments often swing between overvaluation and undervaluation due to his tendency to become overly optimistic or excessively pessimistic. Stamp Guru advises that you invest in stamps only if you would be content holding on to them in the future without being swayed by Mr. Collector's ever-changing prices. However, for the collector who can remain level, hated Mr. Collector offers a fantastic opportunity to profit. He doesn't force you to make a transaction. He simply presents you with a chance to do so. You should be thrilled to sell your stamps to him when he offers exorbitant prices and equally pleased to buy from him when he presents you with exceptional deals. It's worth considering that when Stamp Guru wrote about this, people were not bombarded with constant news, market forecasts, and live price updates as we are today. Back in the 1990s, Mr. Collector would visit you perhaps once a week, along with the arrival of a stamp catalog in the mail. However, in our modern era, he wants to engage with us every time we unlock our smartphones, which, if you're anything like me, happens more than 100 times each day. Just because Mr. Collector visits more frequently doesn't mean you should trade with him more often than people did in the 1990s. If he fails to present an offer that meets your standards, it's best to ignore him and carry on with your day, enjoying your stamp collection in peace. Takeaway number 2, the importance of defensive investing. According to investment expert Graham, there are 2 distinct investor profiles, the cautious strategist and the proactive opportunist. The majority of individuals are better suited for the cautious approach, given their limited availability for investing. For this type of investor, it is recommended to build a portfolio that consists of a balanced combination of different assets, such as stocks and real estate, with an allocation of, let's say, 50 in stocks and 50 in stocks and 50s in real estate. However, it's important to note that the specific allocation may vary based on one's personal circumstances and the current disparity in average returns between stocks and real estate. To maintain the desired allocation, it is advisable to periodically review and adjust the portfolio. For example, if the stock portion of the portfolio suddenly increases to 60s, while the real estate portion decreases to 40, one should sell some stocks and purchase more real estate until the desired 50-50 balance is restored. Another recommended strategy is to invest a fixed amount of money at regular intervals, such as right after receiving a bonus or a financial windfall. This approach, known as consistent investment, allows for a fair average purchase price of stocks and real estate and prevents over-concentration of investments during unfavorable market conditions. When it comes to selecting stocks for the portfolio, the cautious investor should consider the following guidelines. Number 1. Diversification is key. Invest in a range of companies, ideally between 10 to 30, and ensure they are spread across different industries to avoid overexposure. Number 2. Focus on established companies with a significant market presence. Look for firms that generate over $1 billion in annual sales, adjusted for inflation, which equates to approximately $7 billion in today's value. Number 3. Seek out companies with conservative financial practices. A reliable indicator is a current ratio of at least 200s, meaning the company's current assets are at least twice the size of its current liabilities. Number 4. Prioritize companies with a consistent history of dividend payments to shareholders for a minimum of 20 years. Number 5. Avoid companies with a deficit in earnings over the past decade. Number 6. Look for companies with at least 33 earnings growth over the past 10 years, indicating a stable and sustainable growth rate of around 2.9s annually. Number 7. Be mindful of overpaying for assets. The stock price should not exceed 1.5 times the net asset value, which can be calculated by deducting liabilities from the company's total asset. Number 8. Similarly, avoid overpaying for earnings. Keep the price to earnings (PUE) ratio below 15 using the last 12-month earnings as a benchmark. Alternatively, one could consider investing in an index fund, which offers returns similar to the overall market average, providing a convenient option for those who prefer a more passive approach. Takeaway number 3. Approaches for investing as an ambitious investor. Considering the ease with which the cautious investor can achieve average market returns, it might appear simple to outperform the market by dedicating a little more time to investing, right? However, becoming an astute investor and surpassing the market is far more demanding, as this notion implies. It requires patience, discipline, a thirst for knowledge, and a significant amount of time. Unfortunately, many professionals and individual investors lack these qualities and find themselves falling prey to the whims of market fluctuations, as if under the spell of Mr. Market. Let's examine 2 statements made by the chief investment strategist of prominent mutual funds during the dot-com bubble's peak in the early 2000s. We are witnessing a paradigm shift, a new era. We see people disregarding fundamentally sound companies led by capable individuals with visionary insights solely because their stock prices are deemed too high. These statements, despite sounding convincing at the time, turned out to be disastrous for the investors who trusted their money with those funds. Clearly, the answer to the question of whether the stock market is riskier when prices are higher is an emphatic yes. The intelligent investor recognizes that since a company's potential profits are finite, the price one should be willing to pay for that company must also have a limit. Price plays a vital role for the discerning investor. Market tendencies to overvalue companies experiencing rapid growth or those with alluring attributes are matched by undervaluation of companies with unsatisfactory performance. Therefore, the astute investor should avoid growth stocks as much as possible. Why? Simply because investment decisions for such stocks rely more on future earnings, which are inherently less reliable than current valuations. On the other hand, if you manage to identify a company whose valuation is lower than its net working capital, you essentially acquire all its fixed assets, including buildings, machinery, and goodwill, for free. Net working capital can be calculated by subtracting total liabilities from current assets. Such companies were proven to be highly profitable during Graham's investment career, although they are rare in today's market except during challenging bearish conditions. Fortunately, Graham proposes an additional approach for the enterprising investor to discover worthwhile investments. These criteria are similar to those employed by the cautious investor, but with more lenient constraints, allowing for consideration of a broader range of companies. It's important to note that there are no fixed rules regarding company size. While some diversification is still advised, the number of companies held in the portfolio is not set in stone for the active investor. When analyzing a company, the enterprising investor should delve into its annual financial reports. Graham has dedicated an entire book, The Interpretation of Financial Statements, to this subject, which we will explore in greater detail on another occasion. Takeaway number 4. Emphasize the importance of a safety buffer. Eliminating the risk of being wrong is an impossible task, regardless of how carefully one considers their investments. However, this risk can be minimized through a simple principle, ensuring a margin of safety in every investment made. As previously discussed, the price and value of a company are not always aligned. When the price is no more than 2/3 of its calculated value, an investor has identified a company with an adequate margin of safety. Imagine constructing a plane that is designed to transport 20 people, but it sinks if 21 board it. Surely you wouldn't take such a risk. Similarly, investing in a stock valued at $21 when it is currently priced at $20 is unwise. It's possible that your valuation calculation is incorrect. In the first scenario, you might face the wrath of angry, drenched people. Secondly, Your journey towards financial freedom could be delayed by several years. I cannot determine which situation is worse, but I urge you to employ margins of safety. Takeaway number 5. The connection between risk and reward can vary. According to prevailing academic theory, an investor's expected rate of return is directly related to the level of risk they are willing to embrace. Risk is typically measured by the volatility of investment returns, indicating the historical deviation from the expected value. However, Graham challenges this notion and asserts that the price and value of assets often diverge. Consequently, the return an investor can anticipate is determined by the time and effort they invest in uncovering undervalued assets. Defensive investors receive minimal returns, while enterprising investors with their maximum intelligence and skill have the potential for greater gain. Let's consider a different scenario. This story exemplifies the academic perspective of demanding a higher potential reward for assuming greater risk. In the initial offer, you were to receive $10,000 at a 16.7 risk of a fatal outcome. In the second offer, the reward increased to $100,000 as the risk escalated to 33.3. It seems logical, doesn't it? However, stock market investing doesn't necessarily follow this pattern. Remember, price and value are not synonymous. When you acquire a company at 60 cents on the dollar, you expose yourself to substantial potential reward with relatively low risk. Furthermore, if you discover another company available at 40 cents on the dollar, you encounter an even better potential reward with an even lower risk. How could anyone argue with sound reasoning that purchasing a dollar for 40 cents is riskier than acquiring it for 60 cents, merely because the potential reward is higher? Let's summarize the key takeaways. The market often swings between over-optimism and excessive pessimism. Don't allow these fluctuations to influence your perception of asset value. Instead, view them as opportunities to engage with individuals who lack understanding. Defensive investors should build a diversified portfolio comprising of stocks and bonds with a focus on low-price stocks. Enterprising investors should also seek out stocks exhibiting lower price tendencies. Discovering a company trading below its net working capital could lead to a proverbial El Dorado. The intelligent investor must insist on a margin of safety when acquiring assets. Lastly, risk and reward are not necessarily correlated. What are your thoughts on Graham's advice? Do you believe they remain as relevant today as they were in the past? Feel free to share your opinions in the comments below. If you'd like me to summarize a book on investing, personal finance, or money management, please let me know. And if any of the takeaways from this discussion particularly intrigue you and you desire a more in-depth explanation, don't hesitate to ask. Thank you for watching and stay financially savvy, my friends.